Okay, welcome everyone to our second class in financial risk management. Last week we talked about what risk management is, its definition, why it's necessary to manage financial risk. We saw the same argument as in the Modigliani-Miller theorem of capital structure. It works basically the same way, that as soon as you have market frictions, financial risk management can be efficient in the sense that you wreak higher benefits than you have costs. Now, we'll work through these different steps of the risk management process from now on. And we saw that the first step is risk identification. We need to identify those risks that our company is exposed to. And in order to identify risk, we need to know which types of financial risk a company might be exposed to. So we'll first start with the basic distinction between financial versus real economic risks, and then move on to market price, credit, liquidity, op risk, actuarial risk, and then talk a little bit about model risk. So actually what we need to do first is, just as in neoclassical theory, we need to differentiate financial from real economic risks. So financial risks are those risks that originate or at least are related to the financing activities of a company. Could be some cash flows, could be an investment, could be also the financing. So anything that is related to the financing part of a firm, to financial contracts, and which poses a risk to our cash flows, to our company, these are financial risks. So in particular, these might arise from changes in market prices. They might, for financial institutions, obviously, they will arise based on our credit engagement. If we have given out loans, if we've originated loans as a bank, then of course these loans can default and this will constitute credit risk. And finally, any company can get to a situation where it has insufficient liquidity to pay back all its short-term liabilities, its short-term bills. And if that is the case, doesn't need to be a financial institution, can be any company. If that is the case, then you are illiquid and you have liquidity risk. So we can already see within the area of financial risk, we have many different types of risk: market price, credit, liquidity, and we will see some additional risk in this category. Now, all these subcategories have in common that they do not arise directly from the business activities of the firm if we leave out lending for financial institutions. But they originate from cash flows that are originated from these business activities, from these trades, from these transactions. Another common feature of financial risk is that they represent a potential loss. Again, I talked about this last week. Financial risk management is about financial risks in the sense that they originate from the financing, from the financial activities from the company, and they have a financial impact on the company. We are not talking about strategic risks so much. We are not talking about reputational risk. They can be included in your risk management, but financial risk management really concentrates on those activities that can have a financial impact. And risk management will thus seek to reduce those potential financial losses. We are interested in reducing the possibility of financial losses. So that's usually the starting point in risk management, and more precisely in quantitative risk management. A risk is usually proxied by a loss distribution, X tilt, of an investment, and risk management then tries to reduce first of all, identify this risk, then measure this risk by coming up with the hypothetical or measured or estimated distribution of X, and then deriving some strategy how to minimize this potential risk X. So that's, in a nutshell, that's the main idea in quantitative risk management: getting to know what your risk is, X, and which distribution it has, and then coming up with some strategy how to reduce this risk. Now, in contrast to financial risk, real economic risk represents such risk that arise from the production of goods and services by the firm or those that concern them directly. So as a consequence, they involve a number of very different threats to the success. For example, the entrepreneurial risk that you cannot sell your goods or products or services. Result is a decrease in sales. Also, in the end, of course, a decrease in profits, but first of all, you have a decrease in the number of products sold. So this is slightly different from a financial risk where you have an investment. For example, if you've bought a stock, and if the price of the stock goes down, then you have an immediate financial loss. In the case that you are selling less products, that's not really direct. You might have a disruption of the production of goods due to accidents, fires, disasters, similar accidents, the pandemic. Now, these are real economic risks. And yes, they are also sometimes dealt with in financial risk management, but only some of these real economic risks, and then we'll call them operational risk. We'll talk more about this later on in the lecture, because operational risk is a whole category that came into existence through banking regulation, and that's why we'll have to talk about this a little bit more in detail. It suffices to say at this point that operational risk, op risk, summarizes all those risks that are related to a bank's or an insurance company's operations. So having a headquarters, operating a branch network, having the possibility that, for example, you have a fire in your headquarters, and yet that you have an IT system failure. Those are real economic risks that in the end will, of course, also have a financial impact, but they are summarized as op risk. So the discussion is, can risk management help to deal with real economic risks? If so, how? Well, yes. In the case of operational risk, yes, risk management can obviously do something about these risks. For example, if you have the real economic risk of a fire in a branch, in your headquarters, or just in your IT room, then of course you can buy insurance, you can install a fire detector. Risk management can do something about this. But as you can see, many times for operational risk and real economic risks, the methods used to deal with these risks, the methods are quite different from those that we are using in financial risk management. Why? Because installing a fire detector has nothing to do with the financing activities. With a stock investment, you can buy a stock option and you can do a hedging contract, a hedging transaction. In this case, you have a financial risk and you use a different financial contract to reduce risk. In the case of a fire, well, the fire itself is not financial, and the instrument, how to deal with this, how to manage this risk, is definitely not financial. Installing a fire detector is quite far away from using an option or a derivative contract. So yes, risk management can help, of course, to deal with these real economic risks, but with different methods, I would say. Okay, now let's look at those different types of risk in a very practical example. This is the extract from the 2013 risk report of Deutsche Bank. Deutsche Bank being the largest bank in Germany, and in 2013 they published this risk report. Now, it is important to state that banks all over the world, not just in Germany, are required to disclose many great things on their risk exposure and their risk management as part of banking supervision. This is not voluntary. This is mandated by banking supervisors like the European Central Bank, Deutsche Bundesbank, and BaFin. And this will definitely be more detailed than, for example, for a shoe manufacturing company. They probably don't have a risk report in this size. We'll come to that later on. They are forced, and it's mandatory for them under German law to include a chance and risk report, but it might be that they simply have one-liner saying, we don't have any risks, full stop. With banks, it's different. They usually have risk reports of 50, 60, sometimes even 100 pages. So it's not surprising that Deutsche Bank has a very detailed risk report, and they start out with a risk profile stating that they have, let me get a marker, that they have credit risk, they have market risk, they have operational risk, they have diversification effects, and then they have total risk. Now, two things I want to underline here. First of all, it's not by chance that a bank like Deutsche Bank reports 3 categories of risk: market, credit, op risk. There's a reason for that, and we'll come back to that later. It's banking regulation. In one word, or actually 2 if you count the number, it's Basel II. Banking regulation at some point in the 90s said banks should cover and should look at 3 main types of risk: credit risk, market price risk or market risk, and op risk. Second thing I want to point out is that the risk profile and the risk exposure is actually measured in economic capital. Now, what is economic capital? In one word, it's closely related to equity. Let's write down some different words for this. Economic capital is closely related to, and is basically the same as, regulatory capital. And it's, in a sense, equity plus X. And the X is usually set by regulators. Now, what does this mean? Think about this. You have a bank, and how much business can you do? Well, that depends pretty much on your equity, because equity leads to the possibility to bear risk. Now, for example, if you have 1 billion euros in equity, which is not much for a bank, just on a side note, but let's imagine you have 1 billion euros as a bank. This would mean that you shouldn't do business that could cost you 10 billion. Why? Because in that case, if you go bankrupt, you would lose you would lose 10 billion, but actually your creditors, the people, the companies who've given you debt, who've given you loans, you've bought your bonds, they would lose 9 billion in the bankruptcy. So in order, and that's what regulators will do, in order to save the financial and safeguard financial stability, regulators, in contrast to many other sectors, but in banking and financial sector, regulators will say, well, if this bank only has 1 billion euros in equity, they should only do business so that in the worst case, they lose about 1 billion euros. So your equity constitutes your ability to bear risk. That's why you can also call it economic capital, because this is the capital you can work with. So what you're doing is, if you have 1 billion in equity, you can say, well, I can do business up to risk exposure of almost 1 billion euros. And then your equity, at least for internal purposes, becomes sort of a budget, of a capital budget. And you can then say, well, investment banking, you get 500,000, or 500 million actually. Maybe retail banking, you get 200 million. And commercial banking, you get the remaining 300 billion. So you're using the equity you have on your balance sheet, well, only for internal purposes, for capital budgeting. And that's why it is sometimes called economic capital, because you can work with this capital. But I've left out one thing. What is this X? Because we could have also said, well, this is equity, this is Eigenkapital, this is own funds. No, equity, no, let's start in a different way. Regulators and banks at some point said that, well, there is equity and debt, but there is also different types of equity and there are different types of debt. And it may be that some types of debt are actually closer to equity than to debt. For example, if this is debt that is usually almost always gone in case of bankruptcy. If you default, then maybe these creditors have a very small possibility and probability of getting repaid, and they have a very low prioritization when it comes to the bankruptcy filing. So this means that regulators, under the pressure, of course, of banks and bank lobbies, at some point said, okay, let's not just use equity, but you can add certain parts of debt to your equity. to arrive at something that we call regulatory capital or economic capital. And this is what you can see here. This is the required economic capital that Deutsche Bank has calculated. And this, in a sense, is equivalent to the risk exposure in these different types. And you can see, for example, credit risk, corporate banking, securities, global transaction banking, Deutsche asset and wealth management, non-core operations, and so on and so on. So this is the risk exposure, the used up economic capital in these business segments of Deutsche Bank. And obviously, they are also interested in diversification effects. It's rather small, one has to see. Well, actually, no. If you see that it's almost minus 4.5 billion, minus 4.5 billion euros as diversification effects. So the bank has an incentive to look at diversification effects. Why? If you have huge diversification, this will reduce your risk exposure and you have more regulatory capital or economic capital to do new business. You can also now see at this point why regulatory capital requirements, that is, a regulator setting a standard in the sense that you as a bank are required to keep at least, let's say, 10% or 8% capital on your balance sheet. These capital requirements will have an impact on the business side of the bank, because if you say, well, you have 27 billion required capital, but Deutsche Bank only has 25, there are two possibilities what the bank can do. It can increase equity, it can issue new shares, not very likely, or it can reduce business. It will reduce its business activities, and this will lead to a credit crunch, German Kreditklemme. So the bank will not grant so many loans as before, and you can see the negative side effects of capital requirement, but this will hopefully stabilize the financial system. Okay, so we've seen Deutsche Bank singles out market risk, credit risk, operational risk. Liquidity risk is also included, sometimes thought of as a market price risk. So as you can see here, this is exactly the risk types that we will be talking about: market, credit, then liquidity, op risk. And in addition to what banks are concerned with, we'll talk about actuarial risk and something that is always going on in risk management, model risk. So let's start with market price risk or market risk. Market price risk is very simple. It's simply, these are simply those risks that arise from changes in relevant market prices. And as a result, you have unfavorable price changes, price movements, and they arise whenever a good, a product, a service that is required by a company or that you own, if it's traded on one or more markets and the price of that good is subject to fluctuations. As you can see now, anything that has a market price can lead to market risk exposure. Stocks, bonds, securities in general, but also commodities, foreign currencies. I already said commodities. That includes electricity, oil, gas, water, and anything that is traded on the market. So we need to be a little bit more specific, but before we look at those specific types, let's think about this from a historical perspective. Let's say, is this actually a modern concept? No, it's not. Market risk management is actually one of the oldest types of risk management that you can find in the history of mankind. There are some indications that this was already done in ancient Mesopotamia, India, and Greece, where you had very simple hedging strategies and transactions in which merchants tried to reduce the risk that a relevant market price could change. And in many of these cases, these hedging activities referred to raw materials, especially agricultural products. You knew that you have grain, that you have some agricultural products like wheat, and later on, well, tulips. That's very famous later on in history of mankind in Amsterdam. You could see these agricultural products being traded, having a market price, and merchants even 2,200 years ago, maybe even more, trying to minimize the risk that they buy and sell these products for a bad price. So for the due to the demand for such corresponding hedging transactions, this resulted in the first commodity futures and derivatives exchanges popping up, being established over time in Amsterdam, in London, in the United States, and so on. And trading is still conducted today. So some of these commodity exchanges and futures exchanges, we call them actually futures exchanges, these are still in existence. Sorry, my voice is breaking up. Some of these trading exchanges, they are still in existence today, of course, on a larger scale, using computers and having fast and intraday trading and so on. These are obviously modern exchanges, but they go back a long time. And especially futures exchanges were established for the purpose of risk management. Now, these are futures exchanges. These are exchanges on which forward transactions are conducted and settled. And contrary to spot markets, for example, for securities, there's a very simple, two very simple examples here in Germany. You have the Frankfurt Stock Exchange, the Frankfurter Wertpapierbörse, FWB, which is the spot market where you can buy the stocks now and sell them now. And you have the Eurex, that's the futures exchange where you can do forward transactions, in which case you agree now on a contract, but the settlement is in the future. So the delivery of the good you've bought or sold and the money being exchanged, this will happen in the future. So the execution of obligations, delivery and payment occurs only in the future. So that's the difference between a spot market and a futures exchange. Again, let's have a look at the risk report of Deutsche Bank. Market risk. Market risk gets into existence through the uncertainty regarding changes in market prices and quotes, including interest rates. I haven't mentioned this. Interest rates are a price for capital. Stock quotes, currency rates, and commodity prices. Obviously, correlations and underlying volatility also play a role. And again, you can see where Deutsche Bank sees its main risk exposure when it comes to market risk. They also have market risk from trading activities, and they call it market risk management. And you can have a look at this. Maybe you also have a look at the most recent one. They obviously have a risk report in every yearly annual report. And market risk from trading market risk, also trading related default risk and different types of risk. So let's have a closer look at the different types of market risk. First of all, commodity risk, very simple. You buy wheat, you buy oil, you sell electricity. This is where we obviously see risk management and financial risk management being of very high importance to energy companies. Commodity risk is the risk, the potential losses arising from price fluctuations of commodities, that is raw materials. Similarly, losses can also result from the fact that required raw materials are delivered too late, not in the required quantity, only at higher prices. Then, of course, all the prices again will be off. And if you don't get the commodities needed for your production, then again, obviously, you also have a risk. So in the first case, commodity risk generally rises if the prices develop adversely. So if you have, if you own or if you have bought a commodity, the price, if it goes down, you will have a financial loss, and vice versa. And depending on the type of raw material or commodity, the respective market prices can fluctuate to a different degree, and they are also sometimes subject to seasonalities. If you think about agricultural products, this makes sense because, well, you do have the different times of years, you have the different seasons, so it's natural that production will also fluctuate. To get a feeling of what this can look like, you can have a look at this plot. This is a plot where I standardized the prices for ethylene dichloride, VCM, this is aluminum, uranium and butadiene, so 4 different commodities that are not very standard, I admit. And you can see the prices were standardized in 2004 to 1. And you can see the huge difference between some of these commodity prices. So some of them are actually quite volatile. Others, like for example in this case aluminum, the price hasn't changed too much. It's increased over time. That's probably also inflation. There's no inflation correction here. But again, you can see the price for uranium went up extremely and then also went down back again. And this shows you what commodity risk, what high risk exposure it can actually cause. Now, next type of market risk is also very intuitive. It's currency risk. It's very closely related to commodity risk because in many cases commodities are traded in dollars or in foreign currency at least. It's the risk that you have a transaction in a foreign currency, meaning that if the exchange rate, the currency rate changes adversely, you will lose money simply because you are being paid or you have to pay in a different currency, in foreign currency. For example, if you have an automobile manufacturer that produces its models in Germany and sells them in Japan, the production costs are in euros and they are opposed to sales in Japanese yen. So if the exchange rate of the euro to yen, in other words, the market price of the foreign currency yen, if it changes, the car manufacturer receives higher or lower sales in euros for its products sold in Japan. So as one can easily see, in many cases, not always, but in many cases, commodity and currency price risk, they often occur in tandem. Namely, whenever raw materials are purchased in a foreign currency, most of the commodities are obviously bought in foreign currencies, especially if you're doing it directly from your supplier. So in these cases, you will have commodity and currency risk. So the risk manager has quite similar methods available to avoid or reduce this risk. A very simple strategy is complete avoidance. For example, if we are again thinking about the car manufacturer, simply relocate the production site to the foreign market. So that is actually why, among other things, why BMW, Daimler, Toyota, why these large car manufacturers, why they operate production sites in the US, in Europe, in Japan, and so on, because they don't want to ship their cars. They want to produce close to the customers. That's another reason. But also they want the production costs to be in the same currency as the sales. So they don't want to produce in a high labor cost country and then sell their products to a country where the currency rate will reduce your profits. And last but not least, both types of risk can be reduced by doing hedging transactions. You have huge numbers of hedging contracts, derivatives, we'll talk about them later on, derivative contracts, that you can buy and sell on commodities and foreign currencies, and then you can use these hedging transactions to hedge your risk exposure. To see what influence this can have, this is the price for Brent crude oil, the spot price, in German it's Kassapreis, in US dollar versus Japanese yen. And you can see that in some cases, at some points in time, it's the same price. In other points, it's a huge difference. It's a huge difference simply due to the currency rate. And this shows you that if the currency changes, again, both are standardized here to 0, you will see that in some cases, the same commodity will have very different prices simply because of a different currency rate. Okay, now let's think about this in the euro system. Has the introduction of the euro led to a reduction of currency risk? Yes, of course. With a single currency, you don't have any differences in the currency. You have no currency rates. Everyone pays and buys in euro. However, companies obviously still have currency risk with respect to the US dollar, Japanese yen, renminbi. That's even more of a special case. And every time you buy something in a non-euro currency, of course, you still have currency risk. Okay. Next, we have securities and securities risk. That's usually what we mean with market risk, because especially financial institutions will buy and sell stocks, bonds, financial contracts, financial securities, and then this is securities risk. So every time you buy or sell a security and the respective market price will develop unfavorably for the holder of the security, you have security risk. Come on. So all securities traded on a respective exchange, such as stocks, corporate bonds, government bonds, certificates, ETFs on stock indices, they are all subject to the risk that the price changes, usually falling prices if you have a long position. And on the other hand, of course, if the market price is just volatile and therefore a change in price is difficult to predict. And as a consequence, if you're looking at quantitative risk management, the common statistical procedures for dealing and modeling market risk in this area is trying to most accurately estimate the present distribution of those market prices and get a sufficiently good forecast of the future price volatility of the security, or at least estimate potential downward losses. Okay. Now note that in the case of certain securities, it is difficult to draw a clear distinction between price risk and interest rate risk. We haven't talked about interest rate risk, but that's very clear. Interest rates increase or decrease. So every time you have a loan, or you have given out a loan, or you have an interest-bearing security, then you're exposed to interest rate risk in the sense that the interest rate can change. However, in some cases, you will also have interest rate risk when you have a security. And this is particularly the case when the security itself is subject to price changes solely due to the fluctuation of market interest rates. And this is the case for bonds. Bonds are, as the prime example of a fixed income product, bonds guarantee you, usually if it's a coupon bond, it guarantees you a payment of, say, you pay a price P and you get 3, 3, 3 and 103 with a notional of 100. So that's a coupon bond. And as you can see, it has a fixed income because it pays you a fixed interest rate of 3% on 100 euros. So how do you calculate the market price? Well, very simply, you take the 3 and you divide it by 1 plus R, and then you have plus 3 divided by 1 plus R squared, and so on. And you can see that the market price, your opportunity cost of capital, the market risk interest rate, is used in a discounted cash flow strategy to calculate the arbitrage-free price of this coupon bond. So if R increases, let's highlight this. If R increases, you can see you are discounting more strongly, and this will drive down prices. If R instead goes down, if the interest rate drops, well, the price will go up. So this is interest rate risk that is close, basically securities risk. And of course, if this is a corporate bond, for example, of Wirecard, and Wirecard defaults, as it has done, then the bond is worthless. The price will go down to zero, basically to zero. So you will also have credit risk with a bond because it is subject to credit risk. The same with the stock, but one has to be careful. What is the risk of a stock price going down to zero? It is market risk. The price goes down. Here in this case, you could also argue, well, credit risk is the risk that the price goes down to zero, but with bonds you usually include default risk here in your discounting. For stocks, it's a little bit more complicated because stock prices also include future expectations of the company's future business outlook. Okay, so be careful. Market price risk, as well as other types of risk, should never be considered in isolation. You will always have an asset position that is regularly exposed to market risk, currency risk, interest rate risk, as in the case of a corporate bond. And it can also be sometimes the case that if it's denoted in a foreign currency, you also have foreign currency risk. So all these different types of market risk and credit risk even, they all come together. Okay. Now, we've just seen interest rate risk. So let's define interest rate risk. Sorry, my voice is given up again. Interest rate risk, or more precisely the risk of changing interest rates, comprises losses in assets that result from changes in market interest rates that are relevant to that asset position. So the prerequisite is that the price or the asset value depends on an interest rate. If it's not depending on an interest rate, you don't have interest rate risk. For example, some examples are interest-bearing securities, loans granted, securities whose value is determined by a net present value calculation, as we've just seen for the bond. So if these asset positions offer fixed interest payments, fluctuating market interest rates also lead to an indirect interest rate risk in the form of opportunity cost. Now, first example, a bank could have issued a loan at a higher interest rate than agreed. And in this case, the resale value of the loan could change unfavorably for the bank. On the other hand, if the bank does not sell or assign the loan until maturity, the change in market interest rates will not lead to an immediate loss. In the second example, market interest rate changes in interest-bearing securities directly lead to decreasing prices. And the reason for this is that the price of a fixed interest security in the end is equal to the present value of the expected future interest payments plus the nominal investment amount, and thus directly affects interest rate changes in the form of fluctuating prices. So you see that sometimes if you have variable interest payments, if market interest rates go up, well, your variable payments also, the cash flows you receive, they also go up. If, on the other hand, you have fixed interest payments, then the interest rate will have an effect through discounting. Okay. So if interest payments are variable, for example, when the interest payments are based on a market interest rate such as the 3-month Euribor, fluctuating market interest rates usually result in lower losses stemming from price changes. And the reason is changes in the expected variable interest payments, they are compensated or offset by the resulting changes in discount factors. So you receive more as variable payments, but you also have different discounting. So that's the case here. A very simple example, let there be 2 risk-free zero coupon bonds with a nominal amount 100 and a current risk-free interest rate of 10%. And you can see here, you have a bond price P1 for bond 1, 100, very simple. You calculate the arbitrage-free price without any market frictions as the discounted cash flow. So this is 90.90. And for bond 2, where we have a zero coupon bond with 3 periods when it matures in 3 periods, you have 100 and discounted to 75.13. If you now increase the interest rate to 12%, you can see that this change in the market interest rate leads to falling bond prices, 81.29 and 71.18. So direct effect of the market interest rate on those prices. Second example, again, risk-free coupon bonds with a nominal amount of 100 and a coupon of 2% and a current risk-free market interest rate of 1.5%. You get the prices here, and everything else equal. The price of a coupon bond decreases as the maturity of the nominal amount approaches. So that is bonds with fixed interest payments, coupons, plus the repayment of the nominal amount at the end. They will see a decreasing price as the maturity of the nominal amount approaches. And this is something here from practice, from industry practice. This is taken from data stream. This is a government bond. And as you can see here, from the Hellenic Republic, so this is a Greek government bond. It was issued in 95 with a coupon of 5.8%. And you can see the quote, the price, actually, you can see it has, it should have a price close to 100 probably, because the notional amount is 100. And as you can see here, it went down to almost, I think, 50. Actually, let me just see, where is the quote? I think this, oh no, I think this should be, went down to 86, yes. Interestingly, if you now calculate the return, it's almost 57%. 57% for this bond. There was, I think, yeah, this was in 2015. So what can you see? Well, you can actually see one very simple thing. This is a coupon bond from a country that at that point in time we had the euro crisis, and you can see here everyone sold the bond, so the price went down. And in other words, if you calculate the return, the yield, which is nothing but the internal rate of return, well, the return obviously is very high because you get high payments, but also you have very high risk. And the reason for this is, if you calculate this here, this is in comparison a 6% coupon bond from 86 from Germany. The price is relatively stable. It goes down and at some point will go to 100, as you can see here. And you have the euro crisis for the Greek government bond here. At this point, everyone sold Greek government bonds and you got a high return. And after Mario Draghi, as ECB president, said, we will do whatever it takes to save the euro system. Well, investors realized, okay, Greece will not default, and thus the prices went up again. So this is, for the German government bond, definitely the interest rate risk leading to these fluctuations a little bit. But if you see this here for the Greek government bond, this is default risk. This is sovereign risk, the risk that Greece will default. Okay. So how can you explain the different price evolutions? Interest rate and default risk. Okay. So next we'll talk about credit risk, and I will make a short break here so that I can drink something and hopefully recover a little bit of my voice. So I would say we take a 5-minute break and continue in just a moment. Thank you.